Hey guys, uneducated economist here. I want to thank everybody who is, whoops, losing my camera. Prop that back up there so you guys can see the river okay. I want to thank everybody who has been subscribing to my channel. The comments have just been wonderful. You guys are super inspiring. I really appreciate everything. You know, I'm going to try and keep giving you the good stuff here. This one came out of Moody's the other day. You guys know Moody's, the credit rating agency? The credit rating agency Moody's Investors, I got this out of the housingwire.com, by the way, just to kind of let you know. Moody's Investor Services just released a report citing deterioration in the overall loan quality in the mortgage lending market. They go on to say here, the analysts there think the problem might get worse before it gets better. Further weakening would heighten the risk of performance deterioration, a credit negative for certain financial institutions and residential mortgage-backed securities. So any of you who don't know what a mortgage-backed security is when they take everybody's loan, well, not everybody, but they take a bunch of house loans, they jumble them up together, package it for an investor to buy, and then the investor gets the, basically reaps the rewards of everybody paying off their loans. But it says here, further weakening would heighten the risk of performance deterioration. So basically what it is saying is that as things continue to weaken, as the interest rates rise, these things are probably not going to be paying off as well as they have been. That's what I kind of get out of it. And then I love how they talk out of both sides of their mouth here. It goes on to say, for the most part, new mortgages are solid, especially considering the high credit scores, improved documentation, and appraisal practices. A few loans with variable payments, right? So less people are taking out these variable payment loans. Regulatory restrictions on loan officers' compensation agreement would also help prevent riskier lending. So I'm guessing like the loan officers probably don't get as good a commission, so it prevents them from predatory lending. I don't know. Anyway, it looks like they probably won't get as much. The problem is deeper than this. A source of potential vulnerability includes lenders' comfort with high debt-to-income and loan-to-value ratios and elevated first-time homebuyers. So we know the first-time homebuyers are always kind of the riskier crowd. They're the ones who are most likely not going to make it through the entire loan. But it says here that they have high debt-to-income, right? So basically they got their car, their house, or their car, their student loan, their credit card. They got all this debt, and then they're going to pile a house on top of it. Then the house that they're going to pile on top of it, the loan to value, right, the money they're taking out for this house, the house isn't worth that much. And that's what they're stating here with the loan to value ratio being off kilter. Right? Goes on to say, in addition to the broad conditions under which loans are being granted have grown less favorable for future mortgage performance. For instance, home prices are no longer very affordable, and rising interest rates are reducing the refinancing incentives and prepayments. Right? So they're basically saying as these house rises, or as the interest rates rise, you know, there's going to be less people taking out interest or taking out loans for it, and then the loans that are in there, most people are not going to be refinancing them. All right, that's the key to this, refinancing. Right? Similarly, although the U.S. economy is broadly strong and strengthening, right? Mortgages being originated today appear more likely to face stressed environment within only a few years, differing from loans originated earlier during the long period of economic growth. So basically what they're saying there is that if you've taken out a loan here in the last few years, you're going underwater. If you're taking it out, you know, back before the economic growth started happening, you're going to be okay. That's kind of what I get out of that part of it, right? Yeah, not a very good article for those who are in the lending practices, if that's what your profession is. And then what came out a couple of weeks earlier before that was this one that came out of Chicago Tribune. It says BMO Harris, right? BMO Harris has cut back on its bank branch mortgage lending workforce, saying that the consumers prefer to shop for mortgages on the phone, the bank confirmed Monday. The Chicago-based bank declined to say how many jobs were cut, but the Milwaukee Journal-Sentinel recently put the figure at 170 jobs, citing an internal document it reviewed, right? And then it's kind of interesting, if you go on, got this one from the New York Post, right? And it says mortgage lenders cut jobs as Fed rates hike hits home sales, right? So it goes on to say here, the writing is on the wall for U.S. mortgage lenders as their home lending profits tumble. It spells major job losses for more than 350,000 financial workers. Pink slips are mounting faster than the Fed can raise interest rates. The key factor cited for the slowdown as mortgage rates rise, the key factor cited for the slowdown as mortgage rates rise, with as many as 1 in 3 refinancing workers facing the axe. Thousands of other positions are also on shaky ground in the mortgage sector. It goes on to say, the bloodletting is gathering speed with the recent announcements from large mortgage lenders. Among the latest casualties, Wells Fargo said it would be eliminating 638 mortgage professional jobs. JP Morgan Chase is laying off 400. Movement Mortgage is firing 180, and USAA announced 250 job cuts, right? So yeah, it doesn't look good for the mortgage lenders out there. And you know, it's kind of reminiscent almost of being on a job site. Like when we were on these job sites building these condos and stuff, it was amazing. Like when we started doing the framing process where you get the first floor and the first walls and then the second story floor and then the second story walls, pretty soon there's a lot of people who start showing up to the job site, right? You get a lot of electricians, a lot of plumbers, you get a lot of people who are coming in to start working on this building as they put it together. And at one point, it is just stocked with people, right? There is more vans and more, you know, trades, and just everybody's trying to put their part on the house, right? You got the siders on there, the roofers on there, you got electricians and numbers, and it just goes on and on. And then as the building starts coming to the end, you start seeing all these people dissipate, and there's less and less people on the job sites until pretty soon you just get it down to just a handful of laborers who are cleaning up and kind of picking things up and stuff like that, and then the place eventually sells or whatever. But it's amazing to watch how many people are working on that building right in the middle of it all, and then seeing the transfer off, right? Because pretty soon it's just like, hey, we don't need all these laborers anymore. What do you do, right? Well, when you're in the building industry, you don't want those laborers to go find another job. You want those laborers, right? You want to be able to transfer them over to another job so you don't lose all your good help, right? Because you don't want to have to go find all brand new laborers and train them all over again and get them to work with you. You know, you want to have guys that you already know. Well, when it comes to these mortgage lenders, if JP Morgan and Wells Fargo and all these other people thought that they were going to be sending out a whole bunch of loans here in the future, do you think they would honestly be getting rid of all their laborers? I don't think so. Right? The only reason why you get fire or lay off all your laborers or say, I'm sorry guys, you're gonna have to find another job to work to, is if you don't have another job coming up, right? So anyway, that's what I get out of this one. Thank you guys again. I really appreciate it. Love the subscriptions that you guys are hitting on. Love all the comments. It really inspires me. Yeah, thank you very much. And here's a shot of the river for you guys. All right, see ya.